What's going on, everyone? I realized that I have been speaking about SMT, but have never really given a true definition or explanation of what SMT really is. And so I wanted to create this video today just to go into the details and to flesh out what SMT really is. I hope you learned something today. Alright, so what is SMT? It's an acronym that means Smart Money Tool, or you will also hear it being referred to as Smart Money Technique. It refers to a cracking correlation between assets at key levels. So when I say key levels, I refer to highs, lows, swing points, which are also highs and lows, but you have old highs and you have highs that are not so old. And then you have imbalances such as volume imbalances, fair value gaps. So you will find that SMT will occur at these key levels. So why is it important? It is important because it shows the strength and the weakness of assets that you're trading. You also want to trade a stronger asset, and strength is shown through failure swing. So if price was heading to the highs and in, for example, EU made a stop hunt, GU did not. The stronger asset in this case would be GU because it is already going in the direction where price intends for it to go. So it's what I just explained there. Alright, so what I want you to do is look at this chart, and if your charts are open, you can mark up your charts, annotate your charts, and see what you see before I show you my annotations. Right, so if you want, you could pause this video and do that, come back in a minute or so and see the difference, or if we come up with the same thing. Alright, so it's the weekly chart on gold, and you'll see my annotations. So what happened here was we had SMT inside of an internal range liquidity, and that was the weekly fair value gap. So the SMT occurred inside of the IRL, and from that price pushed to the high, took the highs, but also created another SMT. So in comparison to silver would have been the stronger asset in this case because it failed to make the low. If you notice, I'm using the bodies of the candles because you want to see a close below or above the swing point, right? So silver would have been the strongest here in this case, and we would have wanted to trade silver if we were going to take the trade here. If you did not want to trade silver, you wanted to take the chance and trade with gold, then because gold is the asset that you actually trade, then you just use silver as a contrast to tell you what gold will be doing next. And then there was SMT after that push created here. So there are two SMTs in this chart. This is oil with Standard & Poor's GSCI, and I would encourage you to do the same thing. Pause the video and look to see how you would annotate your chart based on what you see here. And this is the weekly chart on oil. Continuing with the annotations, you will realize how many SMTs would have occurred already to move price up and down. So basically, with every movement of price, almost every movement of price is confirmed or validated by SMT. So SMT here, let's start here. SMT at the lows, push price up, if you look at similarly on S&P, you notice that this took the low, this one did not take the low. This would have been the pair to trade, and the one that is the strongest will give you the furthest move. Let me say that too. So this one went ahead and took the highs. This one did not go ahead and take those highs. Created the SMT at the short-term low, and again oil would have been the stronger pair and price moved accordingly. So there were SMTs along the way. We even had SMTs between weeks, in terms of consecutive weeks. So it could be done that way as well, but I just wanted to show you a broader picture of how SMT drives the market. What I will also do is show you the time frame alignment. So for example, as we were on the weekly chart just now, if you see that SMT, let me go back a little. So for example, this gold SMT, so price came to the fair value gap, created the SMT inside of the gap, and now you're looking to take that trade. So the time frame that you would go to is the 4-hour time frame, and that would be your entry time frame. So if the SMT is on the monthly time frame, you take your entry on the daily. If it is on the weekly, 4-hour, the daily, 1 hour, 4 hour, 15 minutes, etc. So the time frames are aligned for your entries, because that's where you will find that the market maker models will play out, in the aligned time frame. Alright, so please bear that in mind. Please bear that in mind. That's very, very, very important. My thought is that SMT is a hidden fabric that's woven into price, but only when you open your eyes will you see it. I'm hoping your eyes are already opened. Alright, so I will go over to the charts and just give you a little more in terms of some price action and how SMT moves the markets. These are pairs that are correlated positively and negatively. You will find that they create SMTs with each other. And these are also pairs that have the same qualities. And so let's move over to the charts. Go here, pull this out, do that. So it's not always that you have to be on the higher time frame, because if you're a swing trader, then you would be using the monthly, weekly, and daily time frames to look for the SMT divergence. If it is that you are an intraday trader, you'd want to be using the 4-hour, 1 hour, 15-minute time frames to look for the SMT divergence, and the entries on the corresponding time frame, or the aligned time frame, as I had just mentioned. Alright, so let's see. Let me just clean the chart. I think I was doing some work on here. Alright, so this is an example as I look. So we had this short-term low being taken, and we had SMT right here. SMT here. Alright, I'm just gonna go through and mark SMTs as I see them, just to help to train your mind. So as you look, you really see them. Let me drop to the 1 hour time frame. I might find more this time frame. So that is a smaller time frame. Alright, this is one. You would have seen this low was swept, while same low at the same time was not swept. The timing is important. So the SMT occurred, so price had a cracking correlation where the swing failed, while this swing did not fail. right? So that's what's considered a cracking correlation. They're doing two different things, which in they're supposed to be doing the same thing at the same time, but in this case they're not, right? So that's an SMT. Let's see what else we can find. There's divergence in here as well. It's here. So this high, you can see the corresponding high on EU that took those highs, while this one, the high, it was a failure swing, right? Let's continue. This is also an SMT divergence. Started here, went all the way down here, and same time, same swing, but price started to go up. So let's say we were looking for this entry here. Let us do that. Obviously price went further, but let's see how this would have played out. So the aligned time frame would have been 5-minute time frame from the 1 hour. We're working with the stronger asset, which is the one that made a failure swing. And let's see what's happening. So you're looking for the candle that swept liquidity. So this is the second leg of the SMT divergence, right? And in this case, this would have been our order block, and because this is the last down candle for that took liquidity and before the move up. So once price closes above this high, you'll notice in your studies that when you have SMT, the PD arrays are more sensitive and they are very valid. So what would have happened? Your entry would have been right on this candle after price would have closed above. Could have even taken your entry on this candle because price closed above on this bullish candle. So on this bearish candle, my apologies. Right, so just close above this high and the entry could have been in the retest right here, or you could have taken an entry right there. So let's assume we took our entry on this candle and stops below here. We have gone to the low, but it's a protected low. We're not expecting price to go back there, and you look for 1 to 2. You're gonna get way more than that, because if we go back to the 1 hour time frame and look at the liquidity draw from this perspective, and if you remember, I think it took this high, and well, it gets ridiculous after a while in terms of the RR that you can get based on using the time frame alignment and where you find that SMT happening on which time frame. And the SMT basically guarantees the push in price, especially if there's a news driver on the day, which most likely, most times, that's the case. And you'll find that big moves will come once there are news drivers in, scheduled for the week. So it might sound crazy, but it's as simple as that. You look for the SMT on the higher time frame, going into an internal or external range liquidity pool. So you can be trading from external to internal or internal to external, whichever one works best for you. And you drop to the aligned time frame, look for that candle that swept liquidity, created the order block. I'm just giving you a strategy. It doesn't have to be an order block. There are different ways to enter the market. If you want to see it as an engulfment, you take the trade after the engulfment, or if you want to see it as an order block, you wait for that expansion and for the return of price to the order block, and that's your entry to go. I hope this was helpful and that your eyes are opening to the wonderful world of SMT, and there are many strategies that can be applied. This is just one. Just keep studying and you'll get there. All right, thanks for watching. Have a great week. Bye.